Hi, I'm Dorian Lamb, and welcome to Start with the Close in Mind. As an owner of a title company and a seasoned real estate professional, I've seen firsthand how focusing on the close is the key to getting the results you want. What I've learned over the years is that this principle doesn't just apply to real estate, it applies to business, strategy, and life. Each episode, I'll share the tools, insights, and real world experiences, both the wins and the lessons learned, that have helped me and others achieve our goals. I will also bring on some of the most successful business minds across industries to uncover how they approach deals, decisions, and success by starting with the close in mind. Welcome to Start with the Close in Mind. Let's dive in. Hello, everyone, and welcome to the next episode of Start with the Close in Mind. Today, I have a good friend as my guest. His name is James Murad. He is the managing director of debt and structured finance at Ripco Real Estate. He knows a lot about how to get money, which is really important for a lot of the contacts and people that we work with. So this is going to be a really interesting show filled with really important information about anyone who needs money, right? So money generally gets the attention of everyone. So James, welcome to the show. If you want, spend a quick minute or two introducing yourself and giving us your background.
Sure. Thanks, Dorian. Thanks for having me on. Yeah, so my name is James Murad. Myself and my two partners, Adam Hakim and Michael Winner, run the debt and structured finance team here at Ripco. We joined Ripco last April. It's gone quick. It's a little over a year already. And our team handles all parts of the capital stack, debt, equity. Our primary focus is transitional assets, being anything where there's a business plan to be executed. That takes you through the gamut of land acquisitions, ground up development construction loans, lease up bridge loans, condo inventory loans, defaulted note acquisitions, note sales. We do plenty of permanent loan business as well, but I would say 85% of what we do is transitional value add business plans. We're middle market focused. 10 to $250 million is the bandwidth we typically play in. And I would say our average loan size is about $40 million.
Excellent. And it seems like it's as simple as we'll find you money from banks or debt or other, private lenders, but it is a lot more involved with that. Before we dive into that, though, let's kick it off. What are you seeing in the debt world today that borrowers should know?
Sure. I don't think it's any surprise that there are a lot of capital providers out there today, right? Probably more than there have ever been. Weeding through the best capital provider for your deal or the slug of the cap stack that you need, that's what requires the nuance. So, you know, everybody's looking for common equity, finding true LP capital. That's the needle in the haystack, right? The groups that are active in that space tend to be more long-term focused. They're not looking at 3 or 5 year IRRs. They're looking at, price per pound of these assets they can buy today and say, this is a general opportunity. And I'm buying an asset at a basis that I could not buy, any time in recent memory. That capital is few and far between, right? So for the people that don't have access to that capital and they have an interesting opportunity they're looking to put together, that comes from a combination of first mortgage and some sort of junior debt or hybrid debt equity product, which is where we're really active. So on construction loans, for example, I would say 70% of our borrowers are choosing to go the debt fund route versus a bank. And they're doing that for a few reasons, right? They are getting higher leverage on a non-recourse basis that doesn't require deposits. Banks, not all of them, but most of the banks that are active in the construction lending space today are capping out at 60 to 65% leverage. And a lot of them are requiring 10% or more of the loan amount to be held in deposits at the bank, which for a lot of borrowers, depending how they're capitalized, that's just not an option.
Right.
So they're going the debt fund route. They're getting, whatever the last couple years was probably 70 to 75% leverage. We're now getting bids from multiple debt funds on, say, a multifamily construction loan at 82, sometimes 85% of cost.
Wow.
And that's really a game changer right now, right? Because 18 to 24 months ago, when those same debt funds were maxing out at, say, 70%, and a lot of sponsors did not have access to family office or high net worth capital for that other 30%. They were finding these really viable deals, but they just couldn't put the cap stacks together. Today, if you can go and get a debt fund to go give you 85% of cost at SOFR 500, finding that 15% of the cap stack is a lot more doable. And so we're transacting on more new projects in New York City in the last 6 months than we have in the last 3 years, which is really encouraging. And I think that's a big driver of it. Land prices have been fairly attractive for a while, but putting those cap stacks together prior had been difficult. And we're working on 3 or 4 active opportunities right now, mostly in the boroughs for new construction residential projects where similar sort of execution, higher leverage debt funds, borrowers able to put together a friends and family equity raise, and the deals underwrite well.
So when you say something, because I remember a point in time, especially with banks, where it was 65% loan to cost, you just referenced a debt fund going up to 85, and they don't require the 10% deposit that a bank would require. So
Mhm,
that sounds too good to be true. Not to say that it can't be, but
mhm.
what are some of the things that a borrower should really consider about taking that 85% from a debt fund? Are there things that they should be mindful of that
Sure.
they get caught by surprise on?
Yeah, look, you need to have confidence and have a sound underwriting that you'll be able to refinance that debt out once, the project is completed. So, depending on your yield on cost, right, and these debt funds are underwriting for a construction loan, I would say as tight as a 7 to a 7.25 debt yield on the projected stabilized NOI, right? In the market today for a perm loan, you're not taking that out at refi, right? So, if you're going to go and take out that sort of debt, you don't want to just bank on interest rates lowering to a point where you'll be able to refi with perm debt at that point. That's how you get yourself in trouble, right?
Yeah.
So the people who are choosing to take that higher leverage are merchant builders, right? Groups that are not looking at long-term ownership. They're going to build it and TCO it
Hmm.
and sell it to somebody else who's going to lease it up and more of a core plus buyer, because you saw that a lot in 2021. Syndicators who went and got 85% leverage at SOFR 250, right? And
Yeah.
their rates ran up and they were not able to refi that debt out. That's how a lot of people got stuck. But there's so much capital out there today that these debt funds that maybe historically have been equity providers, right? They're happy to go to that part of the stack, right? They're getting paid more than a bank to do that. And there are those options out there for those borrowers.
Yeah, that's important to know, right? I mean,
Mm,
look, the name of the show is Start with the Close in Mind, and these are things that people should really be mindful of as they go about embark in getting money. One thing I'm already hearing is the capital stack, especially in the commercial world, is very complicated and can be complicated. Even in your synopsis of what you do, you already referenced debt, you already referenced the middle of the stack, you referenced the equities. For the listeners out there, it really does pay to have someone on your side that is very familiar with all the options out there. Because
mhm.
I've always used the puzzle analogy with what I do in closing deals and providing title insurance, but it is a puzzle as well. Yours being even more important because it's the actual capital in a project, right? So let's dive into how times have changed, right? So it's already been 5+ years since COVID. You referenced a time in 21 where interest rates were really low, right? You said SOFR plus 250. And then you also referenced now a current quote of SOFR plus 500, right? So let's talk about how the market has changed in your mind. And even, to get more specific, just the role of a broker between 21, 23, where interest rates, I would say, caught everyone by surprise and doubled in some cases, almost tripled, and then compared to now. So give us kind of your breakdown of the last 5 years.
Yeah, and I think an important point to caveat with rates is it's not so much the spreads that have run out, right? I mean, the 250 to 500, that's different levels of risk within the capital stack, but it's the index, right? SOFR was as low as 22 basis points, right? And today it's 4.3% approximately,
Right.
right? So even though your spreads may be consistent, right? If you borrowed money at SOFR 250, which means your rate all in at the low is 275, and now your index is 430, all of a sudden your interest rate is, almost 3x what it was when you first borrowed that money, right?
Yeah.
So, if anything, I've actually seen spreads, I guess from a high level today, like we said earlier, there's more capital in the market than there really has ever been before, but there's a lot of interesting products out there, right? And it's important that borrowers, when they're looking at new projects, have conversations with their capital markets providers or, experts as early as possible because there is more capital out there that just wasn't there 12 months ago. For example, our team does a lot of charter school financing in the city.
Yeah.
we're working on a new construction development right now for a charter school in the Bronx. And the options for those sort of deals are there's four real main options, right? There's your traditional banks, there are your debt funds, right? Then there are what we call CDFI lenders, community development financial institutions, which are really aggressive and really value add for developers. And then the fourth is new market tax credits. And timeline is what drives a lot of your decisions with these executions, right? The CDFIs are great, right? They are nonprofit lenders. Their number one concern is not profitability, but investing in their communities and making sure that their loan helps to deliver. There's a variety of do good reasons that they're investing, but we tend to do most of our CDFI loans for charter schools. And the CDFI loans are full recourse, but they're also higher leverage and cheaper pricing than a bank. So for this specific transaction, we don't need to close until Q4 of this year, but our client's a good repeat client and friend of ours. They brought us in as soon as they were close to getting a contract on the site with the buyer. And because we have this sort of timeline, CDFI lenders are the most likely execution, and we have interested parties that are getting us term sheets now. But the additional advantage that we can provide to our borrower now is bringing in new market tax credits, right? And the
Yeah.
timeline to close a loan with new market tax credits really is at least 9 months. So if
Okay.
they had decided to pick up the phone and call me in July saying, oh, I don't need to close until October, I have plenty of time, new markets wouldn't be an option for them because you need to do a lot of diligence and have that package ready for the new markets investors by the fall of that year, just because of when the new market allocations come out every year. So because they had the conversation with us early, we're full steam on that sort of execution. And in an ideal scenario, we'll be landing the plane with a CDFI lender plus new market tax credits will just further blend down the borrower's cost of capital.
Yeah. So in order to get kind of the full entree of the options out there, especially to blend everything to make it we'll call it what it is, as cheap as possible, right?
Yep.
The sooner the better. I feel like if there is a through line between all of the guests that I've had on the show in different capacities of what we do, which is commercial real estate, that it almost is resoundingly get your advisors and partners involved early, right?
Sure.
So it shows that the concept of start with the close in mind, right, is, exactly that. You got to start with the right people and then,
Yep.
engage them early to get all the options that you can, right? And
Sure.
it's pretty much across the board.
Yeah.
So with the role of the broker, have you found any change? I know you've been particularly successful at what you do. I don't think there is a bad thing ever said about you from everyone that I've been around in the industry. And I can attest to that as well. But have you seen, because, oftentimes, even with what I do, right, we are in a sense a broker, an agent of sorts, right, for title insurance, that there's this notion of, I should just do it on my own. What do I need a broker for?
Sure. Yeah, look, I think as a mortgage broker, you always run into that as you're prospecting for new business, right? You're going to talk to people and say, look, you're great at what you do, but I've been in the industry for a long time. I have 5 really close relationships and I had this new transaction and my plan is to use one of my existing relationships, right? And for some people that works and they've got great relationships and no harm no foul. I'll say what we're seeing more consistently today is, look, like we said, there's a lot of capital providers out there, but people are also pickier than ever, right? People are cautious about the world, what's going on a macro level, what are real impacts to real estate values? Have we found the floor on valuation for a lot of assets, right? And so as a result, lenders are looking at opportunities and being very selective with the ones they take on. So what we see oftentimes is we'll talk to a borrower, he's got a great new opportunity. No deal is 100% down the fairway today, right? So it's going to have its nuances. And the borrower makes the decision that I'm not going to hire a broker to represent me in the market. I'm going to go to my relationships. They've done right by me in the past and they're cheap and, that's what I want to do. And what we're consistently seeing now, not all the time, but often, is that borrower has a contract. They need to close on a property in 3 months. They sign it up with their relationship bank. And 45 days into that process, they call us and they say, the bank's committee is having issue with X, Y, or Z issue, and they're walking away. And now I need to scramble and I need to close this loan in a few weeks.
Yeah.
And the truth is, we can get them a loan and close in a few weeks. but the cost of that capital or the type of execution that we're going to get them when we need to scramble and meet that timeline is not going to be as good as if they had hired us 45 days earlier and we had said, okay, look, this deal, the debt yield is a little bit tight, or, you know, you as borrower, you're not going to meet the liquidity requirements of the most competitive banks in the market today, right? But because there's so much capital out there, we know the lenders that will deal with those things and will still provide very competitive terms. Maybe not the down the fairway institutional bank, a slight premium to that, but they'll get you closed well within your time frame, and they'll be cheaper than that option when you have to scramble and close in 3 weeks.
Yeah. Look, it's what happens too when you kind of look, that is a particular area where you guys are extremely strong at, which is in times of duress that you can help find the
Sure.
resource, but ideally
And
you
it's
want to
the
start
reason
earlier.
people hire mortgage brokers, right? If everyone could go right to their relationship capital providers, we wouldn't have jobs, right? But we do have jobs, and we add value to a lot of our clients because of that, right? Because we're navigating these lenders, we're in the market, talking to them on a daily basis.
Yeah.
And the market has shifted a lot now versus what it was even pre-COVID, right? Pre-COVID, our business was largely identifying the 2 or 3 capital providers that are most competitive for a certain box and just going and finding them opportunities that fit that box, right?
Yeah.
Today, there's 50 different lenders for a multitude of different opportunities, and you just need to know what each one's nuances are, what they like, what they can get comfortable with, and what they can't, right? And marrying those capital providers with those deals.
Yeah. And I'm going to help, plug not just you, but the peers in your industry that the relationship counts, not for the sake of just having a relationship, but because they trust your ability to vet a situation, vet a borrower, vet a bunch of things that you're saving the lender from having to do, right?
Mhm.
And in essence, eliminating risk from the relationship standpoint. And I've heard of many situations in which even when a borrower goes direct, right? Or even through a different channel, that if you have a level of trust with a lender, that they can go and get terms, right? So that individual will go to a lender and get terms, and then you would take that exact project with that exact same borrower and go to the same lender and get better terms, right? So
Sure.
it's one of those things where it's very easy to just say I could do it on my own, but there are benefits to work with experts, such as yourself, not just in knowing the nuance of and the profile of all the different lenders, but
Mhm.
you, in a sense, are vouching for that borrower as
Yeah.
well.
And look, I'm not going to go and say that people should hire me because my lenders quote me 25 or 50 basis points cheaper than they quote the street, right? Like that's not very often the case. But what you do hire me for is that when you get that initial bid, is say, well, this is where we've been able to negotiate with them on the last 6 months, on other deals. I know there's going to be very little flexibility in these sort of areas, but we can really push them hard, on these terms. That's what you're hiring us for, right? And for the groups that we do a lot of volume business, yes, we can probably squeak out some preferred pricing. But it's really for knowing where you can push, knowing where there's flexibility and where there's not.
Yeah. You know, it's it's one thing to use you in a situation to bail, a situation out, but and we know that some of the advice is always start sooner than later across the board with advisors, especially the likes of you and I.
Mhm.
But what are some of the other things that the smart sponsors are doing right?
I would say the smart, really active sponsors, right, are, well, I guess it depends, right? But a lot of the more active construction borrowers that we have today, right? Pricing is important, but flexibility on structure, picking lenders that are an easy draw process that can, every construction loan is going to have issues, right? Whether it's budgets or stop work orders or changes to zoning codes, mid construction, these things come up, right? And the borrowers that we find that have the most success and have built a long term career align themselves with lenders that are not just flashing the cheapest rate, but are a nightmare to deal with, right? They're offering flexibility and they're willing to willing to pay a slight premium in pricing for that flexibility. And I think that's really smart. And when we guide our clients on who they're going to get, go down the road with and start a relationship with, that's something we really try to emphasize.
Yeah.
Not about the last 10 basis points of pricing and construction. It's about finding the right lending partner.
Yeah, look, that's super important too, right? Because people get caught in just focusing on the price, but there's an execution standpoint as well.
Hmm.
Not just to close the actual initial loan, but you brought something up, especially in the high stakes environment that New York is for developers, that the draws are important too, right? So, you speak of start with the close in mind. Maybe there's an element here where it's like start with the draw in mind, but
Hmm.
there is something that we come across often, sometimes is a surprise to us, but it's something that we have to work around, in that when a developer makes a draw, that they find out then and there that there's liens that have been filed against them or their project, especially in a place like New York. Aside from being high stakes, it's just very litigious, right? That these things happen, and often, not often. There are times when there's surprise, right? Because the general contractor will say, I don't know about any liens, and then you find out it's a sub, and then it kind of works its way up the chain. But my
Hmm.
point is that everyone's finding out about it on the day that they're making the draw request, which means that somebody needs the money to continue their project.
Right.
Now we got to get around these situations in which there's liens, right? So, one of the particular things, and this is somewhat of a shameless plug for us, but we do have a system where if we're closing loans, we just monitor the property itself from a filing perspective. And anytime anything hits,
Hmm.
we notify the parties that, hey, look, just giving you the heads up that something hit. From a lien perspective, you haven't made a draw yet, but when you do, it's going to become an
Oh yeah.
issue.
Right.
You know,
Yeah,
you
that's a
should.
value add for sure.
You should be aware of it, number one, but number two, if you want your draw to go smoothly, you're going to have to address it sooner than later.
Right. Yeah.
So, these are the things that I want to pull out of getting the experts like you. Is there anything specific with the kind of notion of start with the close in mind? In your case, start with getting the money in mind, that you would recommend to people as a takeaway? Like, what's something, if I wanted money, or if I'm looking to fill my capital stack, let me say it
Hmm.
better, that, what's the thing that I should be mindful of? We've talked about starting earlier than later. We talked about, it's not always about the terms. Is there anything else you would add to that?
I would say start early, right? Be realistic about where the pressure points are with your deal, right? I think that the people that have the most success in the capital markets are not the people that are the best at selling all the high points of their project. It's the people that early on identify these are the challenges with the market I'm transacting in, or the asset specifically, or with my profile as a borrower, maybe even, right?
Yeah.
And these are the challenges that I'm going to have to navigate with my mortgage broker, right? So let's be upfront and honest about what we need to get through, and as a result, align ourselves with a group of lenders that we think are the best fit to navigate those challenges.
Yeah. So,
Versus, oh, don't focus on that. It's great real estate, it's a great basis. Those are all important, right? But the differences between landing the plane smoothly and going through a lot of turbulence are identifying those issues head on.
yeah. So I want to surmise it in a way where I know you would appreciate it, which is the smart borrowers, and the key takeaways: use a broker and use them earlier than not to fill your capital
Yeah,
stack.
we've
Rely on
seen
the
all of
expert.
those issues, right? There are very few issues at this point that are going to come up that we have not dealt with, right? And I can tell you 9 times out of 10, tackling them head on rather than trying to paint a pretty picture over it
Yeah.
is the right way to handle it.
Yeah. So I mean, we find that it's obvious, right? But let's give something that the audience would appreciate. In that, what is something that most people misunderstand about you and what you do?
Something people misunderstand about us. Yeah, look, I mean, I know we just kind of brought this up, but I do think that a lot of people think in their minds, I should hire a mortgage broker if I want to try to save money on my transaction, right? And the truth is that's not the only reason. And in today's market, that's often not the reason that you're hiring us, right? Yes, you hire us to get the best execution in the market, right? Not necessarily the cheapest cost of capital, right? And so we are your advisors, right? We're not guys who are just running around saying, I have 3% money, I have 3% money, send me your deal so that I can get you funded with this cheap cost of capital, right? You're hiring someone who is a professional in the capital markets, that's talking to the market every day, that has a real pulse on how the market is perceiving certain asset types today, where the trends are going, tapping our expertise on a daily basis for the handful of, or sometimes one transaction that you as a borrower are in the market with per year.
Yeah. In essence, the value add of knowing the market, knowing the lenders, not just knowing a lot of things that from a scale and scope perspective, that somebody that is more myopic in the sense of that they're very focused on their project and kind of their resources from an equity standpoint, and their head is more down on whatever geography or whatever type of asset class that they're building
Hmm.
or needing to fill a capital stack for, that you can actually give a more well-rounded, robust piece of feedback because you have a pulse in the industry and a pulse of what's going on out there. There's a misnomer, if I were to help contribute to the thought process here, that you guys aren't saving money because you cost money, right? But it's you can't look at it that way, because think about the amount of time you're saving. You brought up the CDFI scenario, in which that could take 9 months, and that really requires you to engage in a lot earlier, and how much that can save you, right, at the end of
Sure.
the day.
Yeah, and all the things that are not so easy to quantify as far as cost savings of a successful project, right? Being able to pay your subs quickly with draw turns, right? Legal costs when you have to close that loan, right? And navigating a stretch senior loan where you need to have an intercreditor agreement with or between two or three different parties, right? Like these are all things that
Exactly.
don't show up in interest rate or origination fee, right? But flow to the bottom line materially very quickly.
Yeah, they don't show up on Traded. They don't show up on any of
Right.
the stuff that everybody's so, kind of enamored with. I've always answered this question, not just for you, but in the experts that are service providers in commercial real estate, that, and this is more specific for developers, but even sponsors and operators, that the most important thing is the deal itself for them, right? And it, for them to worry about something else, not to say that you're not going to worry about it if you hire us, it's just you have an expert helping you, right? That
Right.
you are now afforded the time to really focus on what you're good at and what's even more important to you and your investors, right?
Yeah.
And
It's a
that's
time
in
consuming
essence what you're.
process to top the market,
Yeah,
There are again, there are definitely some common themes of this conversation, right? There are a lot of capital providers, right? So like we're in the process of closing about a $75 million multi-construction loan in Queens right now. There are legitimately, and that sponsor wanted to go, the debt fund route. There are legitimately 50 to 60 active multifamily construction debt fund lenders in New York City today. Right? And so you need to have conversations with each of them, right? And that's a process that takes several weeks, several hours every day, on that one specific transaction. So,
yeah,
when you're an active developer and you're building 4 or 5 projects at any given time, the truth is, if you want the best execution, sure, you could go pick your 1 or 2 relationships and give it to them and let them run their process. But if you want to ensure that you have the best capital markets execution on each of your deals, you really need somebody who's dedicating that many hours in their week to getting the deal placed for you.
yeah. And I think that serves as the perfect final point, which is that what you're teaching me and the audience is that the options are much more plentiful than they were before. The store
Mhm.
of lenders has gotten bigger between traditional lenders and debt funds and tax credits, right, and CDFI. There's so much out there now that they're really, it does really pay to, in the analogy I use with the store being bigger and there's just more to, more options to buy now, that you have somebody who knows what to buy and where to buy it to help
Mhm.
you through that whole process. So, James, I want to thank you for taking your time here today to, drop some knowledge on us. Where can the audience find you if they need some help with their capital stack?
Sure. Yeah. Thanks for having me. Had a good time. You can reach out to me through LinkedIn. I'm on there. You can shoot me an email. My email is JMUR, A is in Apple, D is in David, at Ripco. You can also find all my contact information on Ripco's website. Feel free to reach out at any time. Happy to chat through transactions, even if it's speculative, not in contract yet. You just want to get our pulse on the market, what we're seeing out there. I would love to chat.
Yeah. Again, thanks, James. So everyone, James Murad, Managing Director Extraordinaire at Debt and Structured Finance. Thank you for your time again. And remember to always start with the close in mind.
Thanks, Dorian.
James.